Good morning and welcome to this In Conversation with Dietrich Domanski, Secretary General of the Financial Stability Board. My name is Andres Portilla and Managing Director and Head of Regulatory Affairs here at the IIF. Welcome, everyone. I will be moderating this conversation with my colleague, Brad Carr, who's Managing Director and Head of Digital Finance at the IIF. So, as an introduction, Dietrich, I was going over your website and I was trying to count how many reports you have produced in the last few weeks. And although I didn't compare with other years, it certainly felt that this has been perhaps the most prolific year for the FSB. It has been quite a remarkable agenda and work plan. So we wanted to use this opportunity to provide our viewers to get a sense and insights into the main areas that the FSB has been addressing during 2020. And obviously, we should begin with COVID-19. There has been an unprecedented policy response to the COVID-19 crisis. And the FSB just recently reported to the G20 on the wide range of measures that policymakers coordinated by the FSB have been adopting. I wanted to ask you about that agenda. How comprehensive has it been? And in your sense, how effective has it been in addressing the main financial implications of the COVID-19 crisis?
Yeah, thank you, Andres. And also, thanks for starting with COVID-19, which has, obviously been a key priority of our work this year. And the reason for that is fairly obvious. I mean, COVID-19 and not just the pandemic as such, but also the measures taken in response, which you could collectively label the COVID event, have tested the resilience of the global financial system. And I think the good news so far is that the financial system has weathered the COVID event, and the supply of finance to the real economy could be sustained. And this is for two reasons. The first is greater financial resilience, and this relates back, I would say, to our earlier work to some extent, in the sense that thanks to the reforms that the G20 agreed to more than a decade ago, and other measures taken by market participants, the financial system entered the crisis far more resilient. And major banks at the core of the financial system demonstrated, in particular, much improved resilience. And unlike in the global financial crisis of 2007-08, banks could and have so far acted as shock absorbers rather than amplifiers. Similarly, financial market infrastructures, particularly CCPs, have functioned well despite the challenging financial and operational conditions. Now, the second reason for the fact that the financial system, global financial system, could continue to perform its function, notwithstanding the COVID shock, is, as you alluded to, Andres, the unprecedented global policy response. Authorities swiftly introduced very significant fiscal, monetary, and prudential policy measures, and these measures supported aggregate demand, boosted market confidence, and more or less directly stabilized those markets that had come under strain. Since the spring, we've essentially in the FSB worked on three fronts. The first one is we've stepped up our efforts to monitor vulnerabilities in the financial system on a high frequency basis, focusing on critical nodes in the global financial system, and to inform discussions about policy responses. And that brings me to the second point, which is a very intense, high frequency exchange of policy measures taken among our members. And that has in turn informed then the third area of work, which has been discussions, assessments of policy measures taken, exchange of views on what has worked particularly well, which measures have been effective and for what reason. And these discussions have been embedded in a strong international cooperation mechanisms. Maybe going into this meeting today, I should have counted the number of calls that we've had since the beginning of the year. I haven't done so, but it more than 20, 30, I don't know, a lot. There has been a lot of high frequency direct interaction in the FSB at different levels and with different focus. Now, where are we going from here? If I may also say a few words about that. As you know, following this initial shock in March, financial conditions have continued to ease, including into the second half of this year. At the same time, however, the economic outlook remains uncertain. And this means, on one hand, that another dash for cash type event cannot be ruled out. But the main theme going forward is likely to be growing solvency risks. And our recent COVID-19 report to the G20 identifies several areas that we need to continue to monitor for signs of stress. The first one is high and rising debt levels. Parts of the non-financial corporate sector are already highly indebted. And as economic activity continues to be depressed in some sectors, corporate indebtedness is likely to rise further, and credit quality at the same time is going to deteriorate further. And this ultimately will lead to higher defaults, even so the number of corporate insolvencies so far has remained relatively low. Second development is related, obviously, is further the credit downgrades, especially fallen angels, which could stress bond markets, not least as many fixed income asset managers are contractually obliged to sell bonds if they are downgraded below investment grade. Now, and we have also seen a number of sovereign downgrades more recently in emerging market economies, which could potentially trigger capital outflows and affect funding conditions, both for governments and for corporates. Now, what does this mean for our work going forward and for the financial system? The immediate challenge is to ensure the financing of the real economy without compromising financial resilience during a period of uncertain economic performance and potentially a slow and drawn-out recovery. Banks' use of capital and liquidity buffers will support lending, help to absorb losses and avoid harmful deleveraging. And a retrenchment of credit or deleveraging could harm the recovery, which in turn would ultimately harm financial sector resilience. So there is an intertemporal relationship, if you like. Stress tests, as you know, suggest that the largest banks are well capitalized and will remain resilient in a range of scenarios, a large range of scenarios. But as banks face rising loan losses, they may be tempted to tighten credit conditions, which could threaten recovery. So there's a clear case for continued monitoring of financial stability risks. There's also a clear case for continued close international cooperation on policy measures taken, discussing their effectiveness, learning from each other, and acting in a coordinated manner as appropriate and necessary.
Dietrich, thank you for that. And we already have a question on this topic that I wanted to bring up. And it relates to this often discussed potential cliff effect that would happen if government support actions and policies are withdrawn too suddenly, leaving the banking sector in particular without a very important tool, which you described has operated very efficiently during this crisis. What do you think is something that the FSB and policymakers could do to address this potential cliff effect?
Potential cliff effects are an important issue, and it is an issue that is featuring prominently in early considerations, beginning discussions about how to eventually, when warranted, start to unwind the measures put in place. Now, what can be done in order to deal with the risk of cliff effects? One is obviously to try to understand the features, the design features of measures that can give rise to cliff effects. And here, when I talk about design features, I would define this broadly. This would also include, in my view, a communication strategy. Mm. And because we know that announcement effects, at least since the taper tantrum, we know that announcement effects can have a very strong market impact. So that is one, discussing, understanding what could give rise to cliff effects. And then a second step is to discuss what this means in practice for the design of an eventual exit strategy. Again, in terms of communication, but also in terms of cross-border coordination. Because if you talk about cliff effects, right, you may think of something that happens between T0 and T1 if a jurisdiction ends a measure or announces to end a measure. But these cliff effects are in many cases likely not just to have domestic effects, but also lead to domestic spillovers. So I think this international dimension, understanding what in terms of cross-border effects might happen, and at least in order, at least give the potential jurisdictions that would be on the receiving end of cliff effects, if you like, an opportunity to prepare and consider measures that they could take from their side in order to alleviate such effects.
Absolutely, and that's one issue that people like Rosso Jimeno have been quite focused over the last few months. I wanted to move on something related to COVID, and it was the March market turmoil that took place earlier this year. You have recently released a holistic review of this report, which actually we're going to cover in full detail tomorrow during a webinar. But I wanted to ask you about the main findings of this report, the causes that the FSB analyzed that led to this March market turmoil, and the possible policy areas that you intend to pursue as a result of this event.
So, I mean, Andres, your first question was in a sense about financial resilience, and we talked about areas of greater resilience before. Now, what we saw in March was an economic shock and related to that liquidity stress in markets that was unprecedented in terms of its breadth and dynamics. And in light of this, there were parts of the financial system that could not absorb or did even amplify market stress. And here, I think we are talking primarily about key funding markets and specific areas of non-bank financial intermediation, or NBFI, as we call it in an acronymized way. Now, this liquidity stress manifested itself in large and persistent imbalances in the demand for and supply of liquidity. And this is what we analyze in our holistic review. So on the demand side, we saw that non-financial corporates attended to tap capital markets. There was huge demand for US dollar liquidity from foreign borrowers. Non-government money market funds experienced significant outflows, and some open-ended funds also experienced material redemptions. Now, at the same time, on the supply side, we observed a sharp reduction in risk appetite. Regulatory constraints, operational challenges may have reduced dealers' willingness to intermediate larger flows of funds in some core funding markets. So taking these elements together, we saw this, what I described at the beginning, as large and persistent imbalances in the demand for supply and liquidity. And public authorities, as you know, had to take a wide range of measures to deal with this imbalance, to address this imbalance, support the supply of credit to the economy in the end. And we note in our holistic review that absent this policy intervention, in particular central bank liquidity intervention, it is highly unlikely that the stress it's highly likely that the stress would have worsened significantly. So looking ahead, I think the main takeaway is that the March turmoil has underlined the need to strengthen the resilience in non-bank financial intermediation while preserving its essential functions and benefits. And it is important to address these issues promptly, since the exceptional measures taken by central banks were not aimed at addressing underlying vulnerabilities that amplify the stress. So in the interest of further strengthening resilience, this is an agenda that is very important. Now, the holistic review, it identifies, in light of the March experience, three main areas of further analytical and policy work. And these are, first, in the short term, work to examine and, where appropriate, address specific risk factors and markets that contributed to the amplification of the shock. And this involves work on money market fund resilience, liquidity risk and its management in open-ended funds, margining practices, and the liquidity structure and resilience of core bond markets, including the role of leveraged investors and factors that have constrained dealers' ability to intermediate. So that's one. The second is efforts to enhance our understanding of systemic risk, so risk in the overall system in NBFI, and the financial system as a whole, because there are close interconnections between NBFI and banks. Understanding these interactions, as well as cross-border spillovers, is an important basis for, or is the basis for, the third area of work, which is about policies to address systemic risks in NBFI, in non-bank financial intermediation. So this third area of work includes assessing the adequacy of policy tools and the concept and desired level of resilience at NBFI. And here I think it is important to note that efforts to strengthen NBFI resilience should not compromise the resilience of other parts of the system, or the important role that NBFI itself plays in financing the real economy. So we, as part of our holistic review, we published a short version of the NBFI work plan that we are going to pursue over the next 2 years, that we will coordinate. As part of that, we will work on an international assessment of identified vulnerability and the appropriate policy responses, obviously in close cooperation with the relevant standard setters and our member authorities.
Thank you for that quick overview, Dietrich. And as I said, we're going to cover this topic in detail tomorrow during the webinar. I want to stay on the topic of systemic risk. And obviously, one of the greatest contributions of the FSB has been the development of a global resolution framework in the areas of banking, insurance, as well as CCPs. You have recently taken stock on how much progress there has been in implementing those frameworks and what are sort of the challenges ahead to complete that implementation. Could you comment on your work on this area and the main challenges that you have identified?
Sure. But before I say a few words on progress made, let me start with one, again, COVID-19 related observation, which is that that it's fair to say that the COVID-19 event has shown the value of the efforts made to improve resolvability. And thanks to the substantial work on recovery and resolution planning over the last years, financial institutions entered the pandemic, which significantly improved capabilities, such as their ability to monitor liquidity on a daily basis or provide more granular reporting of liquidity provisions and disbursements across their institutions, and that on a high frequency basis. So this is, in terms of crisis management or crisis preparedness, a major improvement that directly relates to reform in the area of resolution and recovery planning. Now, by the same token, if you like, the pandemic has also shown that work to further strengthen crisis management preparedness remains critical. So let me say a few words on where we are and what the main challenges are. So for banks, all GSIBs subject to the final 2022 minimum external total loss absorbing capacity TLAC requirement already meet that requirement today. And in terms of disclosure, that of external TLAC levels by GSIBs has improved quite a bit, including over the past year. And at the same time, however, there's still little information available to market participants on the transparency of TLAC within banking groups. And work is ongoing on the management, distribution, and transferability of these resources. And with Andres, we've talked about this issue over the past year, pre-COVID, on a number of occasions in the market fragmentation context. Now, for insurance, there's not too much to be said there. The FSB conducts insurance resolvability monitoring annually across our jurisdictions, but no significant reforms were reported in the past cycle. A number of jurisdictions have identified systemically important insurers for purposes of recovery and resolution planning. This is clearly distinct from the GSI identification. This is for recovery and resolution planning. And key areas of attention for FSB work are intra-group interconnectedness and funding in resolution. Now, CCPs, which is a very interesting area, I should say. So their authorities have made some progress in setting up the necessary structures for cross-border cooperation on CCP resolution, which I think is very good news, a very important step. Crisis management groups, CMGs, have now been established for all 13 CCPs that are systemically important in more than one jurisdiction. And with the entry into force of the new EU recovery and resolution regulation, which is expected to become effective in the first quarter of next year, all jurisdictions with such a CCP would have a statutory resolution regime. Now, more generally, and with respect to CCP financial resources, the recent period of market turmoil has demonstrated the benefits that central clearing brings for financial stability. And the FSB published guidance on financial resources to support CCP resolution and the treatment of CCP equity in resolution. And this guidance aims at supporting resolution authorities and CMGs in assessing the available financial resources for CCP resolution. However, this guidance does not set out policy on the adequacy of resources for recovery and resolution. And in light of this, the chairs of the FSB, CPMI, IOSCO, and the FSB Resolution Steering Group have agreed that they will collaborate on further policy work on CCP financial resources through their respective committees. This will include assessing whether any new types of pre-funded resources would be necessary to enhance CCP resolvability.
Thank you, Dietrich. That clearly remains as an important area of policy work. We look forward working with you on that topic. As you say, it remains as an open question. I wanted to move on to a market issue, which is perhaps one of the main topic in people's minds these days, which is the looming deadline next year for LIBOR transition. You have produced a quite ambitious roadmap for this transition, and I wanted you to comment on the different stages, the goalposts that you have identified in this roadmap, and in general, your advice to financial institutions as to the kind of actions that they should be taking in order to meet that important deadline.
Yeah, no, thank you for this question. As you know, benchmark transition has been a priority for the FSB for quite some time. And this year's G20 presidency, the Saudi presidency, prior to COVID-19, clearly recognizes the risks for financial stability that may result from insufficient preparedness for an end of LIBOR has made benchmark transition one of its priorities. So our reports have to be seen against this general backdrop of a strong political interest at the international, at the global level, to make progress on LIBOR transition. Now, as with everything this year, there is also, of course, a COVID-19 dimension to the topic, and here I think it's twofold. One aspect is that the disruptions in global financial markets that we've seen in the COVID context have further highlighted some of the fundamental weaknesses in LIBOR and confirmed the critical importance of our efforts to reform the structure and use of global interest rate benchmarks. And in July, we reiterated our view that financial and non-financial sector firms across all jurisdictions should continue their efforts to make wider use of risk-free rates to reduce reliance on IBORs where appropriate, and in particular to remove remaining dependencies on LIBOR by the end of next year. So that's one. At the same time, COVID has also, at least in some cases, temporarily delayed specific aspects of the transition plans of individual firms. But the report that you referred to that we published in a few weeks ago highlights that other important programs have been able to continue. This includes, for instance, the release by ISTA of new fallback language for derivatives contracts and the publication of market conventions for loans and other products based on risk-free rates in a number of jurisdictions. So where to go from here? I think transition away from LIBOR by end 2021 requires continued significant commitment and sustained effort both from financial and non-financial institutions across many LIBOR and non-LIBOR jurisdictions. And with only 1 year remaining, all market participants must ensure they implement the necessary steps to avoid disruption to the performance of their contracts. For the transition to occur on time, market participants will need to seize use of LIBOR as a benchmark in all new activities across global markets as soon as possible. And this is a key priority in the months ahead. Andreas, you mentioned our global transition roadmap. This roadmap sets out a timetable for actions for financial and non-financial sector firms to take. And among the important steps highlighted in the roadmap are a few that I would mention briefly here. First, firms should already have, and if they don't, then have promptly identified and assessed all existing LIBOR exposures and agreed on a project plan to transition in advance of end 2021. By the end of this year, so within the next couple of weeks, firms should be in a position to offer non-LIBOR linked loans to their customers. Third, firms should adhere to the ISTA fallback protocol by the date when it becomes effective, and this protocol will enable market participants to incorporate the revisions into their legacy non-cleared derivatives trades with other counterparties that choose to adhere to the protocol. Now, by mid-2021, firms should have established formalized plans to amend legacy contracts where this can be done and have implemented the necessary system and process changes to enable transition to robust alternative rates. And then the end point is by end 2021 that firms should be prepared for LIBOR to cease to exist. Now, given the extent of risks associated with the failure to prepare adequately for the transition, the onus of action, particularly now, is on firms. I mean, this, of course, does not mean that we as FSB or international community will sit idle. We will, through the official sector steering group, continue to monitor and support benchmark transition, and in particular LIBOR transition efforts throughout the next year. And this work will be complemented by an FSB Basel Committee survey on supervisory issues related to benchmark transition, including a data collection undertaken to monitor LIBOR exposure. And this survey is underway right now, and we will discuss this internally and report to the G20 again next year on progress in that area.
Thank you, Dietrich. Then I'm conscious of time. I have a couple of questions from the audience, and I'm going to keep those for the end of the webinar. So let me hand it over to my colleague, Brad Carr, who's going to cover the payments and digital related questions. Brad, over to you.
Thanks, Andreas, and thank you, Dietrich. And indeed, I want to echo Andreas's earlier remarks, Dietrich, for our appreciation for you so generously sharing your insights with us here. And indeed, the fact that we have just so much to cover really is testimony to the enormous amount of work that your team has done in its depth and breadth of topic coverage, all the various reports that came through in October. It was an enormous amount of work for us digesting them. I shudder to think just how much it's been for you and your team in putting all of that together. I do want to give the quick reminder, Andreas just alluded to audience questions. Please do continue sending those through to us, and Andreas and I will look for the opportunity to pick more of those up when we can. But Dietrich, if we could continue by looking at some of the leading digital topics and starting with payments. And on that, I'll start with an open-ended question for you about the FSB CPMI roadmap that was announced recently before we delve into some of the specific building blocks. The FSB CPMI roadmap and building blocks, I think, represent a very comprehensive analysis, but also a very ambitious work plan for the next 5 years. And I was wondering if you could share what you think are the most urgent steps within that roadmap.
Yeah, happy to do so, and thanks for drawing the focus on this really important piece of work, which I think clearly underlines that if we want to promote strong, sustainable, resilient global growth, we need to think ahead of COVID-19. I mean, obviously it's dominating everything at the moment, but I think we need to be mindful that there are important longer term issues that lie ahead that we need to address. And against this backdrop, the G20 presidency last year asked the FSB to coordinate the development of a roadmap to enhance cross-border payments. Now, the roadmap is unique, I would say. It's not unique in terms of the issues that it seeks to address. I think the issues are well known and not new in many respects. I mean, they have to do with the cost of cross-border payments, insufficient speed, lack of transparency, and questions around access or inclusiveness. What the roadmap does is that for the first time, it brings together a coherent, multi-year, multi-stakeholder plan, which has the ability to be a game changer. And reflecting this recognition, the roadmap received a clear political commitment from G20 leaders 1 week ago, who highlighted the need to implement the actions under the roadmap. Now, the roadmap consists of 19 building blocks, which, as I said, provide a comprehensive plan to respond to the issues identified and offer better state-of-the-art cross-border payment services. And let me, as sort of a high-level way of looking at the roadmap, just flag that sort of the largest majority of the building blocks set actions to improve existing payment infrastructures and arrangements. So work in this area will, for instance, seek to widen availability, strengthen links between payment systems, and reduce settlement risk through measures such as facilitating payment versus payment, improving access to systems, extending and aligning operating hours between systems, pursuing interlinking, and exploring reciprocal liquidity arrangements, just to give a couple of examples. So that is one set of measures, clearly recognizing that there is a lot out there to build on. Now, another set of building blocks will examine the scope for new forms of payments, including multilateral platforms, global stablecoin arrangements, as well as central bank digital currencies to address the challenges that cross-border payments face. However, and this I think should go without saying, without compromising on minimum supervisory and regulatory standards to control risks to monetary and financial stability. So these building blocks are all interconnected. Well, some of them are foundational, and will be enablers to others. So this is a great plan. It's an ambitious plan, a comprehensive plan, but key for success is, of course, to maintain the momentum during the implementation phase, which can be achieved through strong collaboration with the private sector, as was done during the design phase of the roadmap. There also need to be obviously clearly defined and ambitious goals. And to this end, the first building block actually will provide overall direction by setting quantitative targets and target dates at the global level for addressing the challenges of cost, speed, transparency, and access. So these targets will be submitted to the G20 next year and will act as a commitment mechanism to drive change in the next 2 years. Just last word, I think if you look at the roadmap, you'll say, oh, this all looks great, but I think it's also important to recognize that cross-border payments is a fast evolving landscape, and the roadmap will have to evolve to accommodate change over time. And the FSB will produce an annual progress report to the G20, and that will provide an opportunity to adjust actions and timelines as necessary. So I stop here.
You made the point there that a number of the building blocks are interconnected, and I would like to just delve into a couple of them specifically a little further. You also made the point there that it's such a fast-moving area at the moment, and indeed, I would probably stress the point that we can't really view payments in a vacuum, and in particular, increasingly, we can't separate payments from data. So if we could talk a little bit about building block number 6, which picks up the linkage between cross-border payments and cross-border data. And this building block, I think, really highlights the role that other regulatory requirements, perhaps in the privacy, data protection spheres, for instance, could have a role in impeding payments. What are the steps forward, do you think, that we can take to address those sort of challenges?
Yeah, Brent, I think you picked one, Brent, you picked one of the sort of particularly interconnected building blocks, indeed. I think as a first step, and first natural step, I would say, we need to carefully analyze existing national and regional data frameworks relevant to the functioning, regulation, and supervision of cross-border payment arrangements. And on this basis, identify issues relating to the cross-border use of those data by national authorities and, importantly, also by the private sector, of course. And to achieve this, we will need the strong support from data protection bodies across the regions. And this is the sort of first step under this building block. And we will conduct this first action in 2021. And then in 2022, consider any follow-up in terms of recommendations as appropriate.
Yeah, I think you're really cutting to the key objective and the key challenge, I suppose, of ensuring that financial regulation and a number of the FSB member agencies that you operate so closely with are connected up with some of those other data regulations in other places. And it makes it a more complex labyrinth, but very much an essential one, certainly. You made the point there that building block number 6 that I picked out is one of the most interconnected. I think it links certainly to number 8, which is has a big emphasis on KYC, identity information sharing. And I was wondering if we could talk a bit about 8 and 16 together on the topic of digital identity more broadly. At the IIF, we've really come to see digital identity increasingly as one of the really foundational technologies of the digital economy, one that has become amplified all the more so this year through COVID. And really as a key enabler for small businesses that are trying to reinvent themselves as e-commerce businesses in the modern economy. So we very much share that focus, and it's central to the Open Digital Trust Initiative. We're focused very much there on the interoperability between different digital identities initiatives. And I was wondering if you see this as one of the other key areas really for public-private cooperation going forward.
I think my short answer is yes. I mean, as essentially most of the actions in the building blocks, this is one I think where close cooperation will be very important. Brad, as you noticed, I mean, actions to increase data quality and allow for straight-through processing will enable more efficient payment infrastructures by, for example, harmonizing technical standards for common message formats and using APIs, application programming interfaces for data exchanges. I think the roadmap has sort of two specific strands of actions, building blocks in this regard. One is, you mentioned them, building block 16, fostering the use of unique global identifiers. And the other is improved digital identity frameworks and shared customer due diligence infrastructures in payments transactions. This is building block 8. So these two will not only be a potential source of increased efficiencies within payment systems, but would hopefully also act as enablers for more consistent application of AML CFT standards across jurisdictions.
Absolutely, very important point. And I like also where you talk a bit about some of the data improvement, data quality work that has been done. And one theme I'm hearing increasingly, a lot of the work that the IF has done together with Deloitte on digital transformation, interviewing leaders around the world, we've heard increasingly this theme that a lot of the remedial data work that we had to do as part of BCBS 239 has turned out to actually provide a very constructive springboard for some of the proactive data activities that banks have been looking to do commercially. If we segue a little bit from payments to another, I think, really significant FSB report, which was the one on big techs in emerging markets, another very comprehensive report. And while it was emerging market focused, I think its learnings and its observations are highly relevant beyond just that scope, especially given the accelerated digitalisation that we've observed this year. The report observed the importance of the principle of same risk, same regulation, and increasingly that the business model of big techs involves entering just selected services or activities within financial services. And of course, we see those selected financial services often then being rebundled with services and activities from other sectors, other parts of those tech firms' core businesses. So I'm interested in your thoughts as to how big a challenge this is, where we might have these rebundled big tech packages that straddle activities that are from both inside and outside of the traditional regulatory mandates, and whether that means that we need to rethink some of the traditional regulatory structures and mandates.
Yeah, this is clearly a very important and very deep question for that gets to the issue of the design of regulation, supervision, regulatory supervisory architecture, if you like, going forward. And I think the new phenomenon, as you know, that we are seeing is not that non-banks venture into financial intermediation. This is something that they've done in the past. But in the past, this happened mainly by businesses whose principal focus was already on financial services, and that for this reason were already subject to at least some form of financial regulation. And now we are seeing financial services provided by big tech firms whose core business lie in technology. And this may actually mean that we need to update and upgrade regulatory frameworks to ensure that their activities are subject to appropriate regulation and supervision. Now, such updates may take different forms, and the report that you mentioned discusses some possibilities. And more generally, it's perhaps important to note that while quite a bit of the big tech related discussion, big techs and finance related discussion is centered on advanced economies, our report, which focuses on emerging and developing economies, also should serve as a reminder that there are quite a few interesting experiences that have been made in other parts of the world with firms, technology firms, that have taken on a very important role in domestic financial systems. In some cases, actually a couple of years ago already. So updates to regulatory frameworks, what could one think of? I mean, at this stage, this is different directions in which one could think. So one example concerns instances where big techs may create new forms of interlinkages in the financial system. For instance, when they offer a range of financial services combined in a single online platform. And this sort of activity could be made subject to end-to-end supervision and regulation, which may necessitate a change to the regulatory perimeter. And I think if you're looking for one concrete example how this could look like, I would suggest that you have a look at our report on regulatory and supervisory issues in stable coins, which essentially tackling this problem that you have an ecosystem at the heart of which you may have a firm that is essentially technology centered. And for this case, our report sets out 10 recommendations on what regulatory and supervisory arrangements should entail. And if you look at these recommendations, I mean, these are high-level recommendations, but if you look at them, I think that you can sense that we would be talking about a combination of, if you like, familiar elements of familiar and established, well understood elements of regulatory and supervisory frameworks, combined with if not necessarily completely new, but at least with modified mechanisms to get a handle on this issue of an ecosystem. So let me just give another example how big tech firms' activities highlight possible alternative approaches to regulation. Financial authorities in some jurisdictions have developed, in MDs, have developed activities-based regulation tailored to the types of financial services introduced by big tech firms. And for instance, some jurisdictions in sub-Saharan Africa have developed specialized regulatory frameworks and licenses for e-money institutions. Other MDs have developed specialized stored value facility regulation for those big tech firms that provide forms of e-money in which users store substantial funds. So again, I think there's a lot going on. There are a lot of interesting experiences to draw on. At the same time, I think, and this gets back to our stablecoin report, there is a case to keep moving.
And I guess, if I try and link together a couple of the themes that we've just talked about there, that there's some fascinating things happening to try and link up these new, non-traditional initiatives that have emerged in payments within certain domestic areas, within certain closed systems. And if I can point our audience a couple of previous webinars that we have with videos available on the IF website, Josephine Anand Ankabar of EcoBank gave some fascinating insights on the work that EcoBank has done on a Pan-African basis, linking up a number of these different payment initiatives. And also Terry Angelos of Visa has talked a lot about the work they've done in linking up some of those different initiatives across borders as well. Dietrich, conscious of time, I might move to climate, and I do want to leave a couple of minutes for Andreas to pick up some of the audience questions. But if we go to climate, and if we can talk a bit about some of the evolving work of the FSB in regard to climate risks and the implications for the financial sector. The FSB conducted a stocktake on how financial authorities are including climate risks as part of their ongoing monitoring, recently released a new report on the financial stability implications of climate-related risks. Wondering if you could tell us a bit about the main findings of these reports and how consistent the evolving regulatory and supervisory approaches to climate risks are, and perhaps what the FSB can do to help promote greater consistency and how coordination with other groups like the NGFS, for instance, how that's taking place.
Okay, this year has been, in terms of climate-related work, quite an active year for the FSB. You mentioned our stocktake report. You mentioned the report on financial stability risks related to climate change that we just published a couple of weeks ago. And in the interest of time and to be brief, I think the picture is one, and this really is sort of a high-level response, if you like. The picture that is emerging is one where there is a growing recognition of the relevance of climate change for financial stability through physical risks, through transition risks. And as our stocktake report shows, financial authorities vary in terms of the degree to which they consider such climate-related risk as part of their financial stability monitoring, in terms of work underway to quantify climate-related risks to financial stability, and also in terms of the degree to which such risks are integrated in supervisory frameworks for banks and insurers. So one important theme that is emerging from our work is that progress to some extent is hindered by a lack of consistent data on financial exposures to climate risks and difficulties translating climate change outcomes into changes in those exposures. In other words, how do you relate a climate event to financial exposures? I mean, these are issues that posing challenges at the moment. And we have now work underway to address, or not, to assess the data, first to assess the data necessary to assess risk to financial stability from climate change and examine potential data gaps. And on your question of coordination, Brad, you're absolutely right. There's a flurry of initiatives going on, and we are in our role as with our broad-based membership, global membership, we hope that we can help in making sure that coordination is in place going forward. It's one of our classic roles. And we are doing this with respect to our climate data work, which is closely coordinated with that of NGFS and other international organizations. So this is the data side. Related but separate, just to mention, is the disclosure side. And as you know, an increasing number of jurisdictions are establishing requirements or guidance for climate-related financial disclosures. And to date, the authorities that have acted have generally said that they will use the recommendations of the TCFD, of the task force on climate-related financial disclosures that the FSB initiated a couple of years ago as a basis. And I think using TCFD recommendations as a basis has a lot of value. First, because these are good recommendations that have received very positive receptions and take up by the private sector. I would encourage everybody to look at the latest TCFD progress report in that regard. But it also has value because the TCFD recommendations provide a common basis, right, and thereby provide an opportunity to avoid jurisdictions, organizations going in different directions, and in the end leading to undesirable fragmentation in this regard. So yeah, I think a lot of work ahead in this area, a lot of coordination need ahead in this area. I think we are well placed to help here and hope that we'll succeed.
It's another great example of how the FSB work plan and mandate has moved with the times, kept pace with the times, and at the same time maintained that sense of wanting to help continue promoting international coordination and cohesion, which is terrific. I'm conscious of time. We've got about, I think, about 6 minutes left. Andreas, I'm going to hand back to you because there's some great questions that have come through, and we might, to some extent, probably finish this discussion where we started it, talking a little bit about the pandemic response and the pandemic framework with some of the questions that have come through. But I'll hand that back to you.
Thank you, Brad. Yes, indeed. We have a great question on procyclicality. We have seen certainly big market moves in regards to changes in the cycle, right? And in some cases, policy has responded in a way that has tightened rules precisely or perhaps at the wrong time. Do you have any work ongoing on assessing procyclicality? Has this been part of your dialogue with some of the global standard setters?
Well, first of all, I should say that procyclicality is a topic that naturally comes to the fore during times like the ones experienced in spring when markets are under stress. So I think as a starting point, it's important to recognize, given the extraordinary nature of the COVID shock, its breadth and depth, the relevant question is not whether there is pro-cyclicality. I mean, there's always going to be some pro-cyclicality in the way the financial system reacts to a shock, an exogenous shock in this case. The question is more, is there, if you like, unnecessary or excess pro-cyclicality that could have been avoided? And I think we've heard in discussions, read in the press, a couple of examples of where there might have been pro-cyclicality. I think we ourselves in our reports at least mentioned two instances. One is related to credit rating downgrades. This is not a new topic, and credit rating downgrades and mechanistic reliance on ratings in particular. And another one is the possibility that some specific aspects of related with margin practices in spring, in particular issues around perhaps insufficient transparency about some margining models and so on, may also have caused surprises. And surprises is sort of the key ingredient, I think, for pro-cyclicality. So coming back to the question, yes, pro-cyclicality is clearly a theme that is on the agenda, unsurprisingly, as it should be, I would say. It is important to frame it correctly, and on this basis, I think it will be part of the discussion going forward.
Thank you, Dietrich. And certainly that's one topic that will be part of the agenda and the dialogue going forward. Let me conclude with one quick question. We only have 1 minute left. And someone is asking, very briefly, very concisely, describe your top 3 priorities for 2021, particularly in the context of an ongoing pandemic that's still with us. What would be your top 3 issues that you're going to focus on?
The top 3 issues, well, top issue 1 is, of course, making sure that there is a strong, appropriate, effective, and well-coordinated policy response to the ongoing pandemic. This is far from over, so this is going to continue the top priority. Related to that is to advance, as I mentioned before, our work on strengthening resilience in non-bank financial intermediation. And the third priority is to make forward with the implementation of the cross-border payments roadmap, because as I said, it's important to look beyond COVID-19. And on that note, if I may add sort of 2 other priorities, climate, we talked about it, and benchmark transition are also very sort of, it's hard to say whether they are part of the top 3 or whether you should talk about the top 5, but these are the sort of the key areas, I would say.
Dietrich, thank you for that and for outlining those priorities. Those are areas that the IIF is looking forward with its members to engage with you in dialogue. Precisely this kind of webinars like today's, it's an opportunity for the private sector and the public sector to talk about these important issues. So let me thank you together with Brad for joining us today. It's been a really great pleasure having you. Thank you, Dietrich. And thank you everyone for listening and watching us today. Please join us tomorrow for a very deep and interesting discussion on the holistic assessment of the March market turmoil by the FSB. And thanks everyone for joining us today. Have a great day.